My name's John Atkins. I'm from ARCADIS Harris. I'll be assisted by Dr. Thomas Herr. We're talking about the subject of technical due diligence in its wider context in the real estate market in Germany. We'll be looking at some of the key trends. As technical due diligence providers, we see the market from its entirety, all asset classes, so we have a good feeling of the trends in the market. We're also looking at the upside, the opportunities and the potential risks in holding assets or releasing assets. So the motto for this presentation is to drive better performance and improve sustainable returns. The roadway that we see as there are two paths. One way is obviously to invest in your existing assets and to return better returns, sustainable returns through investment in the existing asset, or to take another path, either sell or exit. What we've seen in the market is, as we've heard today, Germany remains a hotspot. We have 5 German cities in the top 10 European cities in terms of investment. German investors still dominate with roughly 70%, but there is increasing foreign investment, particularly from sovereign wealth funds, whether they're from Korea or from Middle East. And Frankfurt remains a very strong market. Investment levels reaching pre-Lehman levels, and investment this year has gone up. From our side of the business, we've had perhaps our best year since 2006. Core still dominates, but core plus and opportunistic are of interest. NPL portfolios are returning, and of particular interest is the open-end funds, which have to exit portfolios, which is generating demand for the technical due diligence market. Some key trends that we find from the clients that we work with. Core assets are particularly hard to find. It's a common theme. More clients are looking for long hold positions, particularly sovereign wealth funds will look for a much longer holding pattern and will want long-term positions with their assets. We are currently with ARCADIS Harris, we have a global research department. There is a new paper coming out where we've looked at repositioning and refurbishing assets. I'll comment that to later, but that's becoming more attractive in the core markets. Investors, owners looking to gain more control of their assets in terms of taking a more active and proactive role in how they manage their assets, not leaving it up to the property managers or asset managers alone, but actually taking greater interest in the long-term planning of their assets. We're seeing that investors and particularly tenants are more socially and environmentally aware. We've seen business generated by tenants in their lease renewals demanding different type of asset in terms of more green, more energy efficient, and providing workplaces which reflect their corporate social responsibility requirements. That's an increasing trend. Opportunities decreasing in prime cities, more risk-taking in secondary locations, so that really echoes with what we've heard from some of the other panels, and a shift to sustainable performance. So when real estate assets are acquired, there is far greater proactivity in the long term of that asset, and how can I make that asset sustainable in its performance. What we're also seeing is that investors are far more careful in mitigating risks and selecting the right locations in key cities. In generally speaking, in the acquisitions, there is far more robustness of technical due diligence, legal due diligence. That's a key trend that we're seeing. We've recently done some global research where we've looked at returns in focus interviews across the globe, and we've also looked at investment costs and analysed where it makes sense for refurbishment to be considered in key global markets. This research will be published in the next few weeks. I think REFIRE will have an exclusive on that.
Yes.
Yep. What is interesting, this is just the highlights, that for Germany, 2 markets, Hamburg and Frankfurt, emerged as where you can increase your building value in your current stock through a refurbishment program. For major refurbishments, not for smaller ones it was marginal, but certainly the returns in Frankfurt and Hamburg. Other markets of interest, are Paris and Milan, Amsterdam, Brussels, and US, New York, Chicago, with Singapore and Shanghai. But they're in more, there's different pressures in those markets, but certainly in Europe, repositioning was a trend that has emerged. This particular diagram is really to illustrate the crossroads that we see many investors on, whether to invest in their current assets. We had earlier the topic of whether green makes sense or not, and whether not to invest. And this chart really shows, over a time period of 18 months, some of the key drivers that we have. And really what we're trying to show here is the risk of doing nothing, that you can actually damage your asset value by doing nothing in this particular area. We have the need to be more transparent in the banking field, with greater requirement for risk management through the Equita principles. In an early stage, greater focus on health and safety, generally speaking. We are seeing with a lot of retained assets a shift towards making sure that the health and safety comes first. Over 12 months, we should really look at reducing energy costs and carbon efficiency, particularly important for non-recoverable costs. A large proportion of those are in the field of energy. Our experience is that energy costs in Germany, you can take any asset and make an improvement. Building management systems and softwares have not been updated, and there is quite a large potential in that particular area. Not necessarily putting a green label on it, but energy costs, thinking about reducing your energy costs. We've done that in several key prime cities, particularly in Frankfurt. And then enhancing your sustainable return by really improving your building stock, by looking at making it more attractive to tenants, looking at their corporate social responsibilities, their workplace requirements, and addressing the client need. We've seen that in a number of key cities across Europe, that when the lease comes up for renewal in 2 or 3 years' time, many of these current office buildings or other retail types, other asset types, are not necessarily state-of-the-art compared to what's available in the new development market. This slide is just to show you that if you don't do that, it's not just a question of increasing your market value, there is a risk that you could decrease the value of your asset. So just what we're driving from our business is, if you're managing your assets, look to drive a better performance. That way you'll have a more sustainable return. Look for long-term value. It's particularly important for some of the new sovereign wealth funds. They're looking for 10, 15 year lifespan or longer. You can do this through developing KPIs for the asset and making sure that you don't just look at CapEx but also OpEx and the mixture of the two. So we can see an improvement in the case studies that we've looked at on financial returns by shifting away from a typical asset management approach and putting into place a set of key performance indicators for an asset, including areas like green and energy costs. This can improve rental income also, because you will address tenant needs. You can unlock new income streams. You can achieve a higher capital and social value, environmental and social value. You can optimize the efficiency of your asset. You can reduce risk through greater risk management and governance. And you can start managing your performance through a set of KPIs designed to meet your stakeholder expectations. And you can enjoy better relationships with your tenant if you focus on those particular issues. So a key point for us is in our technical due diligence business, we have across the globe annual turnover in this particular industry of around 30 million. 25% of that is in Germany, and of that revenue that we earn, increasingly more than 50% is in the field of technical asset improvement rather than the transactional business. So we've seen a dramatic shift into the investors looking to improve their asset performance rather than purely transactional thinking. I think Thomas is going to now finish up. Just to see, we're basically available throughout the life cycle of a building. We work with over 50 leading financial institutions in Germany. We have a life cycle of services that we can assist investors from planning, creating, operating, and redefining assets, which is the growth market. When assets reach the end of their life cycle, how can you revigorate your asset? How can you find a new future for that particular asset? Just a word on us. I don't want to talk too much about us, but ARCADIS recently acquired the company EC Harris. I was formerly managing director of EC Harris in Germany. We currently also have RTKL, which is a leading architectural practice, and landlords in Asia, so we have 22,000 employees globally. But I must stress, the most effective market for us in the financial institutions world is Germany, so it's been a very good market for us, and it's we're an innovation engine also for these other markets. Just thinking over to Thomas. Thomas maybe have a counter view or wanted to highlight some of the risks associated with investing in Germany. I've tried to focus on the upside, and Thomas is going to focus on some of the things you need to consider when investing in Germany.
Yeah, ladies and gentlemen, thanks a lot for inviting me, Charles. Thanks for bringing this crowd together. As John already said, I mean, we are both focusing not on a specific field of real estate investment. So we are doing residential, we're doing office, we're doing healthcare, hotels, logistics, but with a strong technical focus, always linked with a commercial thinking. And what differentiates us from ARCADIS is that we are much smaller, and we are focused on the German market and the German-speaking continental Europe. And my impression is, just maybe have a bit of a contrary view to what John just said, that investors are still more focused on risk than on chances when it comes to technical due diligence. So it's not so much about, what is the potential increase of rents in the future, but, what do I have to do to maintain at least the rent levels which I have now? And in doing so, with an experience of roughly 120 billion euros of assets which we assessed over the last couple of years, last 10 years, there's like 6 major items which are in the actual, or in the current market, are the actual risks which we think that an investor should consider. First of it is, of course, connected to fire protection. There's a lot of old buildings. There was one mentioned by Mr. Böhme earlier today, this typical 70s, 80s empty office buildings in Frankfurt, which have a large fire protection risk due to our experience. It's not just that they don't meet current requirements, they even have never met the former requirements, so there's no chance that you ever get a permission to reuse it unless you really for big money install fire detection systems, sprinkling systems, things like that, which needs to be considered and which you probably also not discover during a typical superficial phase 1 due diligence. So this is a major risk. If you ever touch such a building, rather give more money and more time to your technical consultants to really thoroughly inspect these properties. Large risk is also form changes and also alterations in the use of these buildings. We came across buildings which have been built as office buildings and then have been reused into some sort of schools or conference centers with a much higher load of people being in there, which completely changes the codes which are applicable. So this is something you have to carefully look at. And then also a lot of components in the buildings have either not been properly built in or do not have the required certifications. So this is something which also can cost you a lot of money in the future. The second big point which we frequently come across is this item of energy savings, especially with the all harder and more restrictive regulations with the German energy savings codes, NF, where a new novel has been introduced now and will be effective from April next year, which of course puts a lot of pressure on new build constructions, but it also has an influence on existing buildings. Always, if you try to touch part of the building envelope, be it the roof, be it the windows, be it the facade, and you touch more than 10% of the area and you substantially renew it, then you fall under the regulations of the new energy savings codes, which urges you to look at the complete building and not just on the parts of the building which you might need to repair. And this is something which can produce costs which you don't have in your business plan at the beginning. We also have one interesting point here. I don't know who of you is investing in German residential, but with the residential Mietpreisbremse, so with the prospective cut of the increase of rents in the future for newly let flats, it's really still not clear in the coalition talks which are taking place in Germany now if this rental cut will apply also for properties where you do an energetic improvement. So it's really hard to foresee how this Mietpreisbremse, how this rental cut will influence the way of recapitalization of this kind of modernization cost. Because so far the only discussion point I'm aware of is that the rental cut will not be applicable for new build properties, but it's still unclear what happens to substantially refurbished housing. Third point, which is a bit in the same direction like the Energy Savings Code, is other statutory regulations which are very much focused on the quality of water so far in Germany. So you're obliged to inspect the sewage on your private properties, and you're also obliged to improve the quality of your drinking water supply system, which is coming along with higher costs for kind of separating your sprinkler system from your drinking water system, etc. The fourth major point, which costs a lot of money, which is really going into the millions per property, is concrete repairs. All the old buildings from the 70s, 80s, and even from the 90s have a major problem with the defrosting salt harming the concrete structure, and this is a major issue which we come across almost in every building right now. And this is something which is not in the business plans as well. And maybe just one sidestep. We had this question of the building geometry already. I mean, all the old underground parking systems and car parking systems in Germany, they are still up until today following a regulation where the bay width of the parking lot width is a minimum of 2 meters and 30, but the problem is that the cars are getting bigger and bigger, and so you have like a 10 meter 10 wide car which needs to fit into a 2 meter 30 parking lot, so that not just the quality of the concrete is getting worse and worse, also the quality of the parking lots provided is getting or is not sufficient nowadays anymore. So that brings you to the problem if you really replace the existing underground garage, or if you renew the old one. Fifth point is the replacement of building management systems. John already mentioned that it's also a chance, but on the other hand, you all remember the 80s, 90s. We've been so enthusiastic about the new methodology of managing a building automatically, of kind of controlling individually the heat, the light, everything. But all these systems, they have been like on a beta status, and lots of them you can't replace today. So there's no spare parts available anymore. So you really have to invest in a complete new system, which of course gives you also new chances, but it's also a part of the cost which is not considered by many investors. And the sixth and last position here is the disposal of hazardous building materials, which is of course always a big issue in the environmental due diligence. However, our experience is that on a portfolio level, the cost for the remediation of environmental hazardous materials is like 3 to 5% of the overall costs involved in the refurbishment of these buildings. So just on a portfolio basis, you can kind of forget about that. But of course, it can kill you the investment case for a single property always. So you have to be very careful about this one. And there's one new point or new issue came up especially in the Berlin housing market, with people being very nervous about the asbestos coming out of the old flex tiles in their residential properties, and the state housing companies, they've implemented a rule which is completely contrary to all legal regulations. So they take completely out these tiles and also completely the glue which it was fixed onto the floor, and this really creates a lot of new costs, which also for private investors, although it's not necessary according to the asbestos guidelines which are in place. So just let me stop with one thinking, which was also already being mentioned here. What we see on the technical side is that the lifetime of the buildings is getting shorter and shorter. So you have more frequent tenant turnovers. You have more properties available on in a higher status, so that the demand of improving the properties is getting bigger and bigger. And this is where I agree with John. And one point which is reflecting that is the current discussion in the coalition talks to increase the linear depreciation for properties in Germany from 2 to 4%. So that means that the lifetime of a building is not considered to be something around 40 to 50 years anymore, but something around 20 to 30 years. So I think this discussion already shows that we are facing a much shorter life cycle of the buildings, and that of course also increases the capex needs of the buildings. So thank you very much.